Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Brian, thanks for taking some time to join me on the show, mate.
Owen, pleasure to be here.
We just stepped off a recording on our Australian Finance podcast. So I'll put a link in the show notes for anyone that wants to hear Brian's take on some other concepts. I highly encourage you to go and listen to that episode. But for this one, Brian, we're going to go a bit deeper. And when my co-host on the finance podcast, Kate, said, we're interviewing Brian and we're going to interview him about his new book, I just had to ask you a few questions in addition to what we spoke about over there, because I recently watched your microcap club presentation as good reasons to ignore valuation. And I thought, headline, very provocative. I've got to watch this presentation. And it was just awesome. And I just hoped that we would one day be able to engage and we would be able to go over some of these things. So the first question's a real simple one is in the past, you've mentioned that you're a natural saver. You had a high savings rate and you looked for value. How did this lead you to value investing?
Yeah, frugality is kind of like very natural to me, right? Like I'm a natural I think some people are just born savers. Like they're just born to not consume everything. And that is 100% me to the core. So when with that mindset and that way of thinking, when I first became an investor, I was just immediately drawn to value investing, right? Like I don't want to buy anything that's overpriced. I don't want to buy anything that's expensive. I want to buy things that are cheap, right? That's how I shop in the real world. That's how I think. Plus, when you study Warren Buffett, Charlie Munger, Seth Klarman, all the great value investors, Benjamin Graham, the thing they say is what you want to do is buy things cheap. Like that's how you make money. You find $1 that's trading for 70 cents, and that's what you invest in. So that mindset very much appealed to me when I was an early investor. So when I was looking for companies to buy, I was judging them solely based on price to earnings ratio, dividend yield, right? The lower the price to earnings ratio, the better. The higher the dividend yield, the better. And that caused me to miss out on many wonderful companies simply because they got caught in my valuation filter, which is the thing that the first criteria that I put any potential investment through. It was valuation first, everything else second. And what I've learned the hard way is that business quality should be the thing that you first focus on, and everything else should be second.
It's like, because it's so simple, right? It's low price earnings ratio, therefore cheap. We just joked off air about an advertisement that I saw as good and cheap stocks. That's the way our brain is wired. And I think in the presentation you used like what we would call a $2 store, like a discount store, as an example of like we're attracted to big signs that say on sale and things in the bargain bin, right? That's kind of like how we're wired.
That's how some people are wired, and that is 100% how I am wired. So yeah, it was very natural for me to go from shopping for things frugally, trying to pay as little as possible, to shopping for stocks frugally, trying to pay as little as possible.
This I know I'm going to link to it in the show notes, and people can get it from your Twitter as well, your investment checklist. I know some of our analysts at Rask, they saw it and they were like, okay, this is awesome. I love this checklist. And you and Brian Stoffel go through a lot of these things on your YouTube page as well, or channel. If you could sum it up as succinctly as you can, I know this isn't easy, how has your investing approach changed over time? So away from those kind of ratios and that type of value investing, traditional value investing.
Yeah. So again, I'm a slow learner and I'm a natural value investor. So my investing philosophy really started to change dramatically once I started to subscribe to the Motley Fool, and I really started to study the investment success of David Gardner in particular. David Gardner is one of my favorite investors ever, and his investing style, if you study it, is essentially look for high quality, high growth businesses and almost ignore valuation. In fact, one of the things that still drives me crazy about David is like, if a stock is up 50% over the last month or 2 months, that's attractive to him. That's attractive. Like, look, this stock is $30 today. It was $20 a month ago. It's a great buy today. And that it just goes so against every natural thought that I have as an investor. Like, I'm not paying $30 for today for something that was $20 a month ago. That's crazy. But so whereas I think many people are repelled by stocks that are up huge, David is actually attracted to stocks that are up huge. And I saw him make recommendation after recommendation after recommendation of companies that were up big just within the last month, 6 months, year, many of them trading at all-time highs at the time of his recommendation. I can't tell you how many times I saw him make a recommendation and my first thought, my pass. No, I'm not buying this stock. It's at an all-time high. It's at an all-time high valuation, but he kept doing it again and again and again and again. And I saw the results over time. He was recommending Netflix at all-time highs, Amazon at all-time highs, Apple at all-time highs, Activision at all-time highs. And in each case, despite the fact that he was recommending these companies at all-time highs, record numbers, they have just produced massive returns for investors over time. And the reason that David's style is really focus on very high quality business first, get me a high growth, high quality business with a huge opportunity ahead. That's what I care about. And I care way less about today's valuation. I care about what the future potential is. And if you study that style of investing slowly, and I mean really slowly, over time, my investing started to shift away from maybe there's something to this. And when I look back at some of my most profitable stock picks of all time, they were Amazon, which when I bought it was trading at an insane valuation, and it's like a 20 bagger for me. Or MasterCard, I bought at an all-time high. Visa, I bought at an all-time high. Apple, I bought at an all-time highs, and yet they were still multi-baggers for me. So learning that lesson that it's okay to pay up for quality is something that has taken me so long to do, but it's now a vital part of how I invest today.
I think one of the examples that you used too during the presentation was Salesforce, because you were familiar with the software. You knew that it was like eating the business world, so to speak, and resisted buying it. And I can relate to that too. There are so many good products in my life that I've looked at and go, oh, I use this every day, but hey, it's not a good investment because the stock's gone up. Like that's the way you think, right? Your brain's like, yeah, if the chart is at the top, that's not good.
Right. Can't buy this. I missed it. Right. That's I missed it. Right. It's already up too big. It can't go any higher. Right. That kind of thinking can get you into just as much trouble as it can't go any lower.
I think David.
Yes, it can.
I think David Gardner has this thing where he's like, he's going to lampoon buy low, sell high. And that's kind of how we're taught, right? Like buy the cheap stocks, sell them when they're expensive. When it's kind of like the opposite, like buy the good stocks and just keep buying them. Seems to make so much more sense if we look back. And this actually ties into the next question, Brian, which is like one good investment can just dramatically change your investment returns. And even if you're a professional, your career. I don't know if you can relate to that.
Oh, very much can. When I look at the returns in my portfolio, my top handful of mega winners have driven or the vast lion's share of my portfolio's gains, and all of my losers combined, add them all up, is the total losses there is dwarfed by the gains that I've had in Tesla. Like one company, Tesla, has been such an unbelievable outperformer on the upside that it just pays for every single loss that I've ever had. Now, when people hear that, it's natural for them to think, well, then investing is just luck. Right. Investing, if you take away your best performer, your portfolio doesn't look as good. And the truth is that if you look at essentially all of the best stock pickers of all time, many of them can tell very similar stories. My favorite story on that is the story of Benjamin Graham, Warren Buffett's mentor, the literal inventor of value investing. He, in a very serious way, owes all of his outperformance over time to one company. Do you know what company that is? Geico. Exactly. When he bought Geico, I think the year was 1948, he broke every rule that he had in his investing playbook. He didn't get it at a huge discount. He put 25% of his firm's capital into it. It was a way outsized position for him, and it didn't meet any of his investing criteria. However, when he put that much capital into his firm's capital into Geico, he bought half of Geico, and within a period of like 20 years, he had like a 500 bagger on his hand. And that one investment from Geico outweighed all of the investment gains on every other stock that he purchased combined by many, many multiples. That just shows you that, and that's the greatest value investor of all time, the inventor of value investing. He made his fortune. He made a name for himself on a growth stock, a growth stock that he broke his own rules on playing. And that's just how investing works. If you actually crack open the index, right, any of the most successful indexes of all time, it's always a minority of companies, 5, 7, 10% of companies that drive literally 100% of the returns. That's the reason that index funds work so well, is that you are guaranteed to get those mega winners into your portfolio, and they just dwarf the losses of all of the losers combined. So if you're looking at your own portfolio and you're like, well, I only have like 1, 2, or 3 of these mega winners, and I have like just like a sea of losers, that's how investing works. You just don't know that because that's hidden from our view if you're just putting your money in funds.
Brian, one of the things that we talk about a lot on the show, I studied finance. I think you studied business. We talk on the show about discounted cash flow analysis. Our guests on the show talk about, these types of things. How do you use tools like that? Or how do you use, I guess, any valuation criteria? And maybe that we can roll this into another point, which is like the life cycle of companies and how that all interplays into your strategy.
Yeah. What is a business worth today? What is the technical academic reason? What's a business worth today? The answer is the discounted cash rate of all the company's future cash flows into perpetuity. Right? That is a logical academic answer. The only problem with discounted cash flows is it's just advanced guessing. That's it, right? You're putting in assumptions about growth rate. You're putting in assumptions about your discounted return. You're convincing yourself with very sophisticated, fancy math that that ABC company is worth exactly this price today. But there's a thing about predicting the future, in that predicting the future is really, really, really hard. I mean, my favorite example of this is go back until like the year 2000, right? Take the most bullish forecast that you could have found for Amazon.com, right? The absolute most bullish forecast possible for Amazon.com. The analyst that was putting out the information, all the other analysts were laughing at him at how bullish his was. By 2020, I think this was the year 2020, the highest revenue estimate 20 years out was like $26 billion or something, some absurd number. And how much revenue did Amazon do? It was like $380 billion. It was literally 10 or 15 times bigger than the most bullish forecast. So if you were using discounted cash flow models on Amazon at any time during the 2000s, it would have said, nope, pass. Amazon is too expensive. I think that discounted cash flow models have value. I think the most value that they have is when you can take the price and you can do a reverse discounted cash flow. So it says, based on today's price, what kind of growth is assumed to be in the price. And do I think the company can outperform that or underperform that? That to me has value. But for me, I don't use discounted cash flow models. When it comes to valuation, I like to think about an XY axis. And essentially, when I think a company has, I'm gonna use air quotes, unlimited potential, right? Just like massive amount of top line growth potential ahead of it. I don't even look. I ignore valuation altogether. If I think if a company is trading at $1 billion today, the company's market cap is $1 billion, and I say to myself, if this thesis works out, which is a big if, but if it does, if the company captures its opportunity, I could see this being a $10 billion company or a $20 billion company in time. I'm just going to buy it. I'm just going to buy it. I'm not going to worry about the valuation at a time, because the story is the company fulfilling its market opportunity. And if the greatest companies of all time smash even the most bullish, most optimistic projections that analysts can pull out them, they're very rare, but that's how the best companies work. Conversely, if I was going to be investing in a company that was gigantic, had captured a large part of its market opportunity, I would be far more focused on valuation. So if I was going to be an investor in Microsoft today, Apple today, Google today, those are big, predictable companies, or at least more predictable companies than they were 20 years ago. Their hyper growth days are done. And because of that, I'm not going to pay any price for those businesses today. So the bigger the company and the more constrained its potential, the more I focus on valuation. And the smaller the company and the more unlimited its potential, the less I focus on valuation.
Yeah, I think you showed a chart in your presentation, and I think you used data from Boston Consulting Group, where it effectively showed the different drivers of stock returns over time. And once you go out past 5 years, the predominant explanatory variable or variables was growth. Whereas in the shorter term, it was valuation. There was more valuation in that mix. If you think about 100% of the return is explained by what? In the shorter term, it was valuation. Longer term, it was growth, like sales growth, those types of things, right?
Yeah, that's very true, and it makes complete sense, right? If you look at any stock in a normal year, the difference between the high price and the low price in any given year is something like 40%, I think, for like the S&P 500. So the average company in an average non-recession, non-crazy year has a valuation, has a price change of 40% peak to trough. So if you're going to be making money in that company in the short term, it's all going to be based on it. The vast majority is valuation based, right? It's going to be, did I buy at a low valuation? Did the valuation increase? Or did I buy at too high of a valuation? And did the valuation decrease? It makes sense that over a year, that's what drives the returns. But however, when you stretch it out to longer periods of time, to your point, the study mentions 10-year periods. The fundamental thing that drives stock market returns over 10-year periods, 75% of it is accounted for sales and profit growth, period. In fact, the valuation component on a 10-year chart is something like 5 or 10% of the difference in the growth, and that makes complete sense, right? If you bought, I don't have the numbers in front of me, but if you bought Apple 10 years ago, what was its revenue? I don't know, but it's nowhere close to what its revenue was last year. The revenue last year dwarfed its revenue from 10 years ago. So even if you paid a high price to sales, price to earnings ratio 10 years ago, the company's top line has grown so tremendously that the entire value of the business had to go up because the business was doing so much better. So yeah, over long periods of time, it's really growth that determines your return, not valuation. And that's why, since I'm focused on 5-10 year periods, I place much more emphasis on growth and potential than I do necessarily valuation.
Yeah, I think it's when I saw that study, I thought that's like almost really refreshing, because it reinforces that qualitative investment approach, right? Finding the businesses that are resilient, that are high quality. Again, I'll refer to your checklist, where you go out and you try and identify these businesses in the wild, step by step. It's a really good checklist for anyone that's listening. One of the things that I know you like to talk about too is like the life cycles of businesses. And basically the tools you can use to identify businesses at certain parts of their life cycle. I think that's a really important approach for this type of investing, because we want to know which stage it's in. So if we want to pay more for that company, it would make sense. Can you talk to that a little bit?
Yeah, this is something that, again, confused me, especially for people that study the PE ratio like I did. When I first heard of the PE ratio, the price to earnings ratio, it made complete sense to me, right? It makes complete sense to me. If the market multiple is 15 and a company is trading at a PE of 20, it's automatically expensive. Or if it's 25, it's automatically expensive. To say nothing of it's 50 or 100 or 1,000, right? Those numbers are so astronomical, you can't even consider them because it would take you 50, 100, 1,000 years to get your money back, right? Based on the earnings that they have today. But what that undersells is that there are multiple phases that every growth business goes through. When a company is starting on day one, what are its sales? Zero. Right? They're zero. So the price to earnings ratio, the price to sales ratio, the price to book ratio, all those metrics are infinity, right? But would you want to be an investor in Apple on day one? Would you want to be an investor in Amazon on day one? Google? Of course you would. So those valuation metrics in the early days are useless in so many cases. When a company is going through its hyper growth phase, like many companies that come public their revenue is tending to be rapidly rising. However, so many of those companies are reinvesting in themselves to drive that future growth that their current expenses is higher than they would be if they weren't investing in themselves. For that reason, if your expenses are artificially inflated because you're in growth mode, your earnings are going to be artificially deflated, understated. The earnings power of the business is going to be understated. For that reason, the price to earnings ratio is going to look inflated because earnings are below what the true earnings power of a company is. So when a company is growing very rapidly, the price to earnings ratio is often a useless metrics to look at because it looks like 100 or 1,000 or whatever it is. So when that's the scenario, I think that the thing that investors should do is look further up the income statement to get a better idea of value. Now, I love the PE ratio when it works. Like that's my favorite metric for valuing companies. The problem is it doesn't work on a lot of companies because they're not optimized for profits. They're optimized for growth. So if you want to figure out how to value a growth company, you just move further up the income statement. So price to EBIT is better than price to earnings in some cases, or price to gross profit is better than price to earnings, or price to sales is a better guide when a company is growing rapidly than price to earnings. But the more mature a business gets as it continues to grow and mature and its growth rate normalizes, that's when the company switches from focusing on growth to focusing on profitability. And when a company is fully optimized for profitability, bingo, that's when the price to earnings ratio starts to work. Finally, if a company is in the decline phase, if it's being disrupted, or if its business is rapidly heading towards zero, this is a really tricky time for investors, because if you look trailing, it often looks like these companies are trading at 5 times earnings and they have dividend yields of like 8% or 10%. And you're like, oh my God, this business is so cheap. However, if those earnings are rapidly trending towards zero, it doesn't matter how low of a price to earnings ratio you pay on them, you're going to lose a whole bunch of money. So that, I think that the graphic, if you can share it with your audience, is just a good mental model for investors to have in their mind for when the price to earnings ratio is useful or useless.
And I definitely will, because it's super valuable, and I'll share the link to the presentation as well. I thought I might just sneak in one more question here, mate, which is what factors would matter more to you than valuation?
So one exercise that I think everyone should go through that picks individual stocks is very similar to what I did when I was creating my investing checklist, which we point out is freely downloadable on my website. It's a good starting point for people. First thing investors should do is write down for themselves all of the attributes in a business that they find attractive. For me, that's things like strong balance sheet, high gross margin, high returns on capital, positive and growing free cash flow, positive and growing earnings, founder-led management team, low customer acquisition costs, high inside ownership, et cetera, et cetera, et cetera. I have like 30 things that I wrote down that are positives. At the same time, make another list. What are the things you don't want to see in an investment, right? What's negative for you? I don't like losses. I don't like negative free cash flow. I don't like debt. I don't like accounting problems. I don't like customer concentration. I don't like it when a company is dependent on a commodity price or an interest rate for it to do well. Like, I don't like airlines because they need low fuel prices to do well. So for me, the entire sector is forget it. How can I predict fuel prices? I can't. So therefore, how can I predict what the stock will do? I can't. I don't like high dilution. I don't like it when the company's when currency impacts a company's financials, et cetera. So I have my two lists: good things, bad things. Then I allocated 100 points to the list of good things. And this is a really, really important exercise, because it's one thing to have a list of criteria. It's an entirely different thing to weigh them according to the factors that you really like. So limit it to a set number. I chose 100 points. And then I started dishing out points based on what I thought was most important, all the way to least important. And I did the same thing with the negative. Finally, I have this checklist that I can put companies through, and the checklist weighs the factors according to my criteria for, is this a match for me? And what this allows me to do is run companies through at any given time, and I can, in a matter of like an hour or so, figure out, is this company a good match for my investing style, or is it something that I should pass on? So as I said, you can download my checklist for free. Take it. I highly recommend. Take it, modify it, add things you like, subtract things you don't, make it your own. But I think the process of going through that process is incredibly valuable.
Brian, pardon me. That's fantastic. I've never thought about it in that context of make it your own, in the sense of like, what's important to me. We do that on the financial wellness and literacy side of things. We want people to feel good about their money, and we want to understand how lifestyle impacts that, but never investing. So I think that's a great base. And like you said, your checklist there, which I'll link in the show notes and put that graphic in from before, will be great resources for people. However, there's one more resource we should talk about, which is your book, Why Does the Stock Market Go Up? I love it. It says it on the tin almost. Tell us a little bit about the book.
Yeah. So when I started investing in 2004, I was reading voraciously every book that I could get my hand on. And I've read all the classic books about Buffett, Lynch, Klarman, Graham, the Motley Fool's books. So many of them are excellent. They're really wonderful tools for learning. However, I never found a book that really answered the most important question that I had about investing, which was, why does the stock market go up? Like, we've all seen the chart, the 100-year chart of the S&P 500, the Dow Jones. It's just bottom left to upper right. I'm like, I get that this has happened. I get that it's been a great investment. Why? What is the thing that causes the stock market to go up over time? And for so many books, we're just like, yes, the stock market is going to fall, but it will come back. It always comes back. So that has always confused me as to why does the stock market fall? Why does it always come back? And there was just never a book that explained that very concept in an easy way. So after talking with a couple of my friends a few years ago, they were finally like, well, maybe you're the one that's supposed to write it. So I was like, okay, I guess I have to write a book now. So yeah, the book just came out. I'm super proud of it. And I really, really did focus on making it as easy to read as possible. Like, they're all short chapters. It's at a 5th grade reading level. Anybody, no matter where they are in their investing journey, can understand the concepts that are in the book.
Fantastic. And to that point, you can pick it up and you can give it to anyone. You can give it to your kids. You can give it to your friends that want to get into the markets and want to learn about investing. So it's a fantastic book. I'll have all the links in the show notes. Brian, thank you so much for taking the time to join me on your afternoon, my morning.
Thank you so much for being here, Alan. I appreciate you waking up early to speak to me.
Cheers.